Welcome to Life Plan Differently with Rick Dwyer from Argallus Financial Group. In this podcast, we'll help you connect your personal expectations to your financial realities. Join us for this journey where we take a holistic approach to financial planning as Rick Dwyer draws from years of experience and guest experts to teach you how to avoid costly mistakes in your financial planning.
This is the Life Plan Differently podcast with Rick Dwyer of Argallus Financial Group. I'm Patrice Sikora. This time around, Rick will tackle life insurance. Now, most of us undoubtedly think we understand life insurance, right? It's something for when we die. But Rick, you say there is more, a lot more, and actually this is a really powerful financial tool. Tell me about that.
Yeah, thanks, Patrice. So I believe, unfortunately, it's one of the most misunderstood financial tools that people can have in their toolbox. And a lot of times when we mention life insurance to folks, we'll normally see them roll their eyes back and they'll kind of glass over. And the first instinct for many people is, well, I don't need any life insurance. I got plenty of life insurance. And, I hear all sorts of reasons of why they don't need life insurance. But the reality is most people don't know all the different things that you can do with life insurance. So obviously the primary use of life insurance is if you should pass away prematurely, that your heirs, if you're married, your spouse, and if you're not married, maybe you have people that you're responsible for or charities that you want to take care of, or maybe you have some obligations that you want to make sure are resolved upon your death. So those are traditional uses for life insurance. But it is a very, very powerful tool, and it is a tremendous wealth builder. In other words, depending upon how you have your life insurance put together, what we like to refer to it as properly structured life insurance, it will actually accumulate wealth throughout your lifetime. Now, once again, there are no absolute guarantees. This is a financial product, and it is dependent on the ability and financial strength of that insurance carrier. But the carriers we deal with are all rated or better. And in many cases, these companies have been around for over 100 years and have been through both the ups and downs of the economic cycle. So these are very strong companies with long track records and very strong balance sheets. So we're going to get a little bit more into this, I think, as we go along. But I think the very first thing I'd like people to know on this particular podcast is don't just assume because of things that you think you know about life insurance that it's not something that you should revisit or at least consider, because in many cases, it's a way to complement other things that you're doing with your financial planning.
But Rick, wait a minute. Life insurance, isn't it just for me when I die?
Well, it can be for you when you die, but nowadays life insurance can do much, much more than that. So as an example, many carriers now include what's called critical, chronic, and terminal illness riders that are actually included within the policies themselves. You don't pay anything extra, they're already included. So what does that mean? So let's say, for example, you had a $1 million policy and you were diagnosed with a terminal illness. Well, many of these policies will advance up to 90% of the face amount. So in this particular case, it could be $900,000 to you to help get your affairs in order while you're alive, and it's all tax-free. So that's one benefit. Now, that's on terminal illness, and we all hope that we never have to utilize that, and I understand that. But it's nice to know that there's a tool that will give you that capability if it happens. Just as with terminal illness, you can also have chronic and critical illness. And those are conditions such as heart attack, stroke, cancers, different ailments that can impact your ability to function and may actually diminish your life expectancy. And also included with that are significant cognitive impairment, such as dementia, which would include Alzheimer's. So those can be very expensive items. And once again, life insurance properly structured that includes these what are called advanced benefit riders or living benefits will advance a portion of the face amount. So once again, on that $1 million policy, Depending upon the carrier, it could be 2% of the policy value per month. So 20,000 a month could be advanced, or 240,000 a year. And that would go until you've reached about 90% of the policy value once again, at which point there's no more benefit from that policy, but you've now taken up to about $900,000, give or take, depending upon the carrier. You've received that money tax-free, and hopefully it's enough to help you get your house in order. And in this case, I do mean two things when I say house: your house literally, in case you need to do any remodeling for any changes that need to be made due to your current circumstances, as well as your financial house. You need to make sure that things are set up not just for you if you're single, but if you're married and have children, you need to make sure that your financial house is in order for them as well.
Now, Rick, does this supplement long-term care insurance?
It can. There are a number of people who have long-term care, and this would be a supplement to that. There are a number of people who don't have long-term care. They're afraid that they're going to be spending money on something they'll never use. And quite frankly, that's an objection I hear a lot with life insurance, especially from people who are single. Well, I'm single, and when I'm gone, I'm gone. I don't really care what's left over. And you know what? That may be something that makes sense for you. Maybe you just need a shorter term policy, maybe a term policy, because in most people's, in the case of most people, there will be some final expense obligations that need to be taken care of. And if you're one of those people that's not an issue, well, then maybe life insurance is something that you don't need. So life insurance is not something that everybody needs, but it is something that should be looked at to ensure that anybody that has obligations or has money that they want to be used to address certain criteria that they've set up, whether it's for, once again, charity, or to go to a religious foundation, or to help support a family member, then you want to make sure that you have something in place. And the best way to do that is with life insurance, because the leverage that you get on your premium dollars is just substantial. In other words, if you set it up right, the amount of money that you're putting into the insurance is significantly less than what you would ever have to put into savings to get those same dollars back.
Now, I think traditionally we think of life insurance as something to help you protect your family. It still does that, doesn't it?
Oh, absolutely. As I said before, if you're married, I mean, one of the primary uses is to help protect your spouse. And if you have children, your children. But if you're single, you may also be responsible for someone else. It could be another child from either a previous marriage, or it could be from someone else in your family that you're taking care of. You may be concerned that you have a sibling that you need to take care of. There's many times we've come across clients who have a brother or sister who has some sort of disability, and they want to make sure that that sibling is taken care of when they pass on. And also, they just want to make sure that any obligations that they have are taken care of as well. So yes, life insurance is meant to take care of certain financial obligations, whether that's a family or something else, as we've just discussed. And that's the primary use for life insurance, but there are many other uses as well.
All right, so tell me about some of those.
We can talk both from a family perspective and also from a business owner perspective. So I'm going to talk about from a family perspective first. So if you have a properly structured life insurance, then that life insurance will build value over time. And why is that important? Well, let's just use a very simple analogy. People spend money to buy things all the time. So I'm going to use the purchase of a car as an example. So to keep things simple, we're going to say that the car is a $30,000 car. And Patrice, we're going to assume that you're the one that's going to the dealership to buy the car. That'd be okay? You want to play along?
Sure. What color?
Well, you get to choose the color. But let's say by the time you're said and done, you're at the dealership and the dealer comes in, you've gone for your test ride, you love everything. And the dealer says, Patrice, we can tell we really like you. So here's what we're going to do for you. We're going to give you that car for no money down, and we're going to charge you 0 interest. How does that sound?
Okay, sounds pretty good.
All right, so already 0 down, 0% interest. So right now you're thinking this car isn't going to cost me anything. So they're going to finance it over 5 years, 60 months. So that works out to $500 a month. So let's go down the road. You've made your payments for 5 years. And at the end of 5 years, your $30,000 is where?
It's in the car.
Well, it's actually with the finance
Okay,
company
yep.
that you paid to get the car. But now you own the car. The
Right.
car is now 5 years old. What do you think that car may be worth in 5 years?
Oh, it certainly isn't $30,000.
No, let's just assume for a second that that car is worth $15,000.
Okay.
Seem fair? Maybe it's worth more, maybe it's worth less, but we'll just say it's worth 15.
I've been very careful on the mileage, and I've kept it in good shape.
Okay, so we're going to assume 15,000. So now let's take a step back and see what's really happened. You spent no interest, but in reality, you paid $30,000 for a $15,000 asset. So if you keep spending 30 to get 15, how much wealth are you really building?
I'm not.
You're not. You're losing 15,000. Not a really good way to build wealth. Now, here's where it gets really exciting with life insurance. So let's say you have a properly structured life policy. You have over 30,000 sitting in the cash value portion of your policy. And now you're ready to buy a car. The dealer comes up and he gives you the exact same terms. And you say, you know what? That's awesome. But you know what? I'm just going to pay cash for it. So this time you do the exact same thing, except instead of getting the financing from the auto company,
you're getting it from yourself.
You take it from yourself. But here's where the magic happens. You take that $30,000, you give it to the auto company, and now you own the car.
Right.
You pay the same $500 a month back to yourself. At the end of 5 years, where's that $30,000?
It's in my pocket.
It's back in your insurance policy. What's the car worth?
15 maybe.
Still worth $15,000. What's the difference? 15,000 versus 45,000. So now you spent 30,000, but on top of having your money back, you have a $15,000 asset versus spending 30 and winding up with 15.
I like your math, Rick.
So that's an amazing way of doing it. And here's the real catch that really gets people thinking that this just sounds too good to be true. Well, in addition to keeping your money and getting what you want, that money that you borrowed is also earning interest at the same time. Now, granted, when you borrow from a policy, you're paying interest, but on the types of policies we use, we have a couple choices. We can do what's called a zero interest sale, meaning that the money that you're borrowing and the interest that you're paying have the exact same interest rate. So there's absolutely no charge in interest. So in essence, the exact same deal you were getting from the auto dealership. Or you can get interest if there's any credited above and beyond the cost of the interest rate on the loan. So in other words, let's say your loan interest rate was 4%, but that year you earned 8%. Well, in essence, you're earning 4% on money that you've already spent. And that's where it starts to get really exciting. So I just want to summarize real quick. If all you did was not earn any interest at all, and all you did was make the wash on the interest that you paid, as well as the interest that you earned through your insurance policy, you still wind up with $30,000 more because you did not transfer that $30,000 of your money to someone else. It now stayed with you. So you wound up with your money and the car. That is a huge difference. And when you start to think about all the different things that people spend their money to buy, such as furniture, vacations, you name it, if they were to utilize their insurance policy to do those same things, then they literally can become their own banker, get what they want, and also keep their money. And that's where the magic really starts to happen.
And that's it. You're paying the loan off, but you're paying yourself that loan.
Right. So the reality here is that if you're going to pay the money anyway, if you borrow from yourself and you become your own banker, well, then be a responsible party and pay yourself the same money you would have paid someone else. This way you get to keep your money and keep what you want. Because, you know, there's a whole discussion when you're getting into budgeting and financial planning. You need to separate your needs from your wants. Well, if you get the right policy in place, you can get what you need, but you can also buy what you want and keep your money at the same time.
I like the idea. I like it a lot. Now, in your notes here, you've got something called wealth transfer. What is that?
So, sometimes we're meeting with people and, they've come in for their retirement planning, and maybe they have, let's just say $1 million saved up in total. And they want to have a certain amount of money that gets transferred to their heirs. And so one of the questions that we will ask is, how do you want that money to go to them? Do you want it to go to them taxable or tax-free? Well, inevitably, everybody answers tax-free. And we said, well, what if we could take the portion that you were interested in providing to your heirs and giving them even more, but doing it with tax-free dollars? Would that be of interest? And of course, the answer is obviously yes, we'd be excited. So let's say out of the $1 million, they were planning on transferring $200,000 to their heirs. And maybe that was their grandchildren, so it would get them a head start and allow them to pay for college.
Mm-hmm.
Well, in many cases, we can turn that $200,000 into maybe $300,000, $400,000, $500,000, but this time it's all tax-free, doesn't have to be paid back, and now they can pass it on to their kids through the life insurance. It's already pre-set up, it's prepaid in advance, and eventually when they pass away, that money is going to go to their beneficiaries. And if anything were to change in their life, where for whatever reason they want to change who those beneficiaries are, they have the ability to change their beneficiaries at any time. But this is a very efficient way to transfer money and do it in a way where it's tax-free.
So you can actually use life insurance when it comes to estate planning.
Yeah, in fact, one of the big reasons for life insurance also is what we call estate equalization. So let's say you're a business owner, or maybe you own a farm, or you own something that's going to be passed on to maybe one of your children. And maybe you have 4 children. 3 of the children have no interest in being involved in your business, no matter what it is. And the 4th child does. So the 4th child's going to inherit the business. But the parents also want to make sure that the other 3 children also get an inheritance that's on par with what the 4th child's getting.
Mm-hmm.
So what we can set up is a life insurance policy that will pay off each of the children that did not inherit the business an equal dollar amount to what the 4th child's getting with whatever that business or farm is. And maybe it's not a dollar for dollar exchange. It really gets into planning and what's involved. The bottom line here is that through life insurance, we can help equalize what all the heirs are getting so that no one feels like they got cut out because they didn't want to be part of that business.
Gotcha. So this kind of does move us into the whole business realm here. How can life insurance help someone with a business?
Well, as we just said, estate equalization is one way, but there's a number of ways for business owners. So one of the key things is, with business owners is, let's say there's a partnership. We'll do a partnership first. So you might have 1 or more partners that are in the business. So what happens when one of the partners dies or wants to leave? Well, normally what's set up is a buy-sell agreement. I have seen many businesses that have buy-sell agreements, but they have no way of funding that buy-sell agreement.
Oh.
So life insurance is a way on the death of someone that it could trigger the sale of the deceased assets, which would then pass over. They would get bought out by the remaining partners. And for buying out, the proceeds would then go to the deceased partner's heirs. And in many cases, the wife and or children or both. So that's one way of taking care of on a buy sell. Another way is, let's say you have younger partners and you have an older partner. You can go ahead and pre-fund the policy so that at a certain point in time, the younger owners or partners can then take over the business, and any cash value that's in that policy can then be used towards the purchase of the business from the primary partner. And there's a lot of things to get involved in that have to be gone through to make sure the buy-sell agreement is structured properly with the attorneys involved, as well as the accountants from a tax perspective. But life insurance is a very powerful funding mechanism that's used in many buy-sell agreements. The next big business use is what's called key man insurance. So maybe you own a business and you might be the heart and soul of that business. And you may have people that are there that can run the business, but they don't have the same type of, let's say, sales ability that you have, or maybe you have something on the design side of a particular business, but you have some component of skill that maybe the others don't have. By having a key man policy or key person policy on anyone who's a key driver of your business, and something should happen to them where they pass away, the life insurance will pay off, giving you dollars to go out and effectively hire a qualified party to then come in and replace them. If you don't do that, then not only are you probably going to be losing a substantial amount of business, but you have no dollars to compensate for the loss of revenue, as well as looking for a package to help bring someone else on board to replace that person.
Which also brings up the question of retirement. I mean, if I'm retired, do I need life insurance? I mean, I'm not in a business. I probably have some kind of will that disperses all my assets, but do I need life insurance?
So it depends. And once again, if you're single, if you have no one else that you need to take care of, and you have no obligations that you have to be considered with, and all your final expenses are paid, maybe, there is no need for life insurance. So it really just depends. But let's take a married couple, and we'll assume that one of them dies and leaves the other one single. Well, here's a couple things that happen. If that particular spouse had a pension, in many cases, that pension is either eliminated unless they had a pension continuation option, in which case the surviving spouse may get 100%, but in many cases, it's less than 100% of that pension. But however, nowadays, many people do not even have pensions. But I just want to address pensions because we have a lot of military in the area, and we do use a program and strategy called pension optimization, which allows us to replace someone's income, but let them go ahead and maximize the pension income they would get. And if they pass away, the life insurance would actually pay their heirs enough money to replace their full pension amount. And it's usually more cost effective than taking the full pension option from your employer. Mm-hmm. But once again, that's just a blanket statement, and a lot of due diligence would have to be done, and we'd have to look at the terms of their pension from their existing employer.
Right.
Okay, so that was pensions, but let's talk about something more specific. Let's say Social Security. When one of the spouses passes away, the surviving spouse gets to keep the higher of the two Social Securities. So that means at least one of the Social Securities is going to disappear. So that's one financial issue. But here's the second, and probably I wouldn't say the bigger, but a big issue, is that you just went from married filing joint to now you have to file single.
Right.
And that means your income tax rate is going to go up dramatically. And if you need to maintain anywhere near the same lifestyle that you had when your spouse was alive, that means you have to generate the same amount of income, but now you're going to be paying a much higher tax rate, which means you have to sell off even more assets to pay for that same lifestyle, just to pay for the tax portion that's going up. So taxes is a really big reason to make sure that you have some tax-free dollars coming in to help offset the loss of income that's going to be resulting from either a potential loss of pension, but definitely a loss of Social Security, as well as an increase in the tax rate. So those are a couple things that we want to be concerned with, even when we're retired.
How do I know what insurance would be best for me?
Well, there is no blanket answer. I mean, it really just depends. And there's too many variables to say, this is what you need to have. What you really need to do is sit down with someone, go through what your needs and desires are and your goals, figure out, does it make sense? Or let me back up. Do you already have what you need in place to compensate for the increase in taxes or the loss in Social Security or potentially the loss in a pension income? If in fact you have all of those in place, then maybe you don't need life insurance. But one of the things that's really great about life insurance is that you can create an instant estate. So if you're not quite at the level where you wanted to be when you're retired, one of the things that life insurance can do for you is when you do pass away is you can leave to your spouse and or your heirs a substantial amount of tax-free dollars that would not have been available any other way.
Right. All right. I haven't life insurance, Rick. I have it. So should I do anything?
That's a great question. So a lot of times we'll have people come in, and part of our process in our discovery meetings to find out what people have. And if they have a life insurance policy, we'll ask them to bring that in and we'll do a review. Recently, we had a client, he's 74 years old. And when we reviewed his policy, we were able to increase his face amount 38% without increasing his premium at all. So mortality rates have just come down again. The latest mortality rates went into effect on January 1st of 2020. So what that allows people to do is, depending upon how long they've had the policy, we may have substantially lower rates, which would enable them to either have the same amount of life insurance for a lower dollar amount, or have a higher face amount for the same dollars they're currently paying. So it always makes sense to get your current policy reviewed and see if it makes sense to do any changes. And in some cases, it does not make any changes. So as an example, if you had your policy from, let's say 15, maybe 20 years ago, and you got rated, let's say preferred plus, but in that time frame, your health deteriorated significantly, it may not make any sense to make any changes. So it is, or I should say, there is no one case fits all again, as in most things in financial planning, but it's always worth getting a review to see if there are any options that are available to not only improve what you're able to get on your existing policy, or compared to your existing policy, but also to see if there are any additional riders, such as the accelerated benefit riders we talked about, which are now pretty standard on most policies. So not only could you increase the face amount, which we did for the policyholder I was just talking about a few minutes ago, by 38%, but in addition to that, there was also living benefit riders that were included for chronic, terminal, and critical illness. So he not only got a substantial increase in face amount, but he got additional benefits that weren't included in his existing policy. So once again, no blanket answer on should you or should you not have it. But if you do have insurance, I do think it makes sense to at least get it reviewed and find out if what you have is optimized for you, or if there are other options that may be available to you.
Rick, how can people get in touch with you if they'd like to talk to you more about life insurance?
Well, once again, they can call us at our office number, 904-800-7299, and set up a time to have a conversation. And the next way is to go to our website. We have a lot of information on our website, and that is Argallus, ARGALLUS.com. Those are the two best ways to either start to learn some things about our company, or to go ahead and just set up an initial 15-minute discovery call.
You know, Rick, I think you've just put some new life, into the way we think about life insurance. Rick Dwyer of Argallus Financial Group. To subscribe to upcoming episodes of The Life Plan Differently and to listen to those already available, just use the subscribe button on this page. You can also share with friends and colleagues using the share button. I'm Patrice Sikora, and let's talk again later.
Thank you for listening to the Life Plan Differently podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Argallus Financial Group, Inc. or Capital Management Services, Inc. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service providers with any questions you may have regarding your investment planning.